Before you touch some other buck in your 401k, let me ask you a question. Would you rather look rich on paper or actually keep more money after taxes in retirement? Importantly today, I'm going to display you how the wrong choice between a 401k and a Roth IRA can cost you over six figures in taxes and how to fix it while you still have time. Let's first with the basics. Interestingly, but for a grown-up's point of view, not a 25-year-old on TikTok, a traditional 401k is usually through your employer. You put in pre-tax money. That means you skip paying income tax on those contributions today. They grow tax deferred. Obviously, and later in retirement, every dollar you pulling out is taxed as ordinary income. In 2026, if you're still working and under 50, you can put $24,500 of your own money into a 401k. If you're 50 or older, you get a catch-up. Another $8,000 for a total of $32,500 you can stash away in that plan. Now, the Roth IRA is diverse. You put in after-tax dollars. You already paid the tax, the money turn. If you follow the pattern, every qualified withdrawal in retirement is tax-free. And both what you put in and all the growth. For 2026, the Roth IRA boundary is $7,500 if you're under 50 and $8,600 if you're 50 or aged, because there's $1,100 catch-up for folk in your age group. There is a catch. If your income is too high, you may be phased out of contributing directly to a Roth IRA. In 2026, you can put in the extensive amount if your income is under about $153,000 as a bingle filer or under $242,000 as a married couple filing jointly. As your income goes above those ranges, your allowed Roth contribution shrinks until it hits zero. Sometimes, so 401k, big limits, pre-tax bow, taxable later, Roth IRA, smaller boundary, tax now, tax-free later. Quick check-in. If I offered you $500,000 in a 401k or dollars, actually, $500,000 in a Roth IRA, which would you choose? If you state Roth, you're already thinking like a pro. Let me display you why. Let's meet two neighbors, Linda and Christmas Carol. Both are 62. Let me put it this way. Both work hard. Both have done the right thing. Linda relieved mostly into her traditional 401k. Carol split her savings between a 401k and a Roth IRA over the years. They each have $1 million saved across their history. Let me put it this way. The thing is, on the surface, they look equally prepared, but their tax future is very alternative. Linda decides she needs $60,000 a year from her 401k to live comfortably on top of $24,000 of social protection. All of that $60,000 from the 401k is treated like salary in the eyes of the IRS. After standard deductions, she could easily owe several thousand a year in federal tax. Besides, and because of that extra income, up to 85% of her mixer security can be taxed as well once her compound income crosses $34,000 if she's single or $44,000 if she's married. Carol, on the other hand, designs it differently. Maybe she takes $40,000 from her traditional account and $20,000 from her Roth IRA. The Roth climb down do not show up as taxable income. That means less of her Social Security is tax. Her sum taxable income may fall into a lower bracket. Her Medicare premiums may be lower because those are tied to income bracket 2. Here's the emotional punch. On paper, Linda and Carol are both millionaires because she mixed in Roth dollars. But after taxes and Social Security taxation, Carol may keep decade of thousands more over a 20 to 25 12-month retirement simply. In a few minutes, I'll show you the exact funding order of magnitude I recommend, how much to put in 401k, how much in Roth IRA, and in what sequence, especially if you're 55 or aged. So stick with me. Now let's pull the camera back and look at the pattern that really topic if you're closer to retirement than to your first job. Here's why this matters. Number 1, part limits in 2026. Honestly, we already said 401k, employee deferral bound $24,500 under 50, plus an $8,000 catch-up at 50 plus for a total of $32,500. Roth IRA, $7,500 plus $1,100 catch-up, total of $8,600 at age 50 asset. If you're in your tardy 50s or early 60s and still working, those catch-up contributions are productive. Frankly, they let you shovel spear carrier money into tax advantage buckets right when retirement is getting close. Think about it this way. 2. Required lower limit distributions, RMDs. Here's a big one nobody explained at orientation. For traditional 401ks and traditional IAS, you must get go taking required minimum distributions at age 73 under current law for most people. You can delay the very number one till April 1st of the year after you turn 73, but then you're on the hook every year. Those forced withdrawals add to your taxable income whether you need the money or not in reality, which can pushing you into higher bracket and trigger more sociable security tax income. Definitely. Now, here's the twist. Indeed, Roth IRA have no RMDs during your lifetime. You can let that money turn untouched as long as you inhabit. Indeed, start in 2024, Roth 401k balances are also exempt from pre-death RMDs thanks to the Secure 2.0 Act. Although employer plan rules still matter when you leave of absence a job for you, that means Roth money gives you flexibleness. Besides, you decide when to pull it, not the IRS. At the end of the day, pause with me for a second. Imagine you're 75. To be honest, you do not want the money this year. You're healthy. Grandkids are doing well, but the IRS says, nope, you must pull tens of thousands out and pay tax anyway. That's the feeling a lot of folks have when they hit RMD age with nothing but traditional account. Part of my job is to help you avoid that surprise. Interestingly now, I'm not here to beat up on 401ks. Used correctly, they're one of the best tools you have. Let's talk about the strengths number 1, employer match. Say 4% or 5%. If your employer hush offers a Lucifer, that's on loose money. If you earn $100,000 and get a 5% match, that's $5,000 of extra pay passing straight into your retirement every 12 months on top of what you contribute. Compound that over 20 to 30 years. On top of that, we're talking hundreds of thousands of dollars in extra retirement assets, higher limits, and current tax break. The high 401k limits we talked about, up to $32,500 if you're 50 plus in 2026, are a huge advantage if you're earning a good income and want to reduce your tax bill this year. For example, if you're in a combined federal and state marginal bracket around, say, 22 to 24%, every $10,000 you put pre-tax into a 401k could save you about $2,200 to $2,400 in current tax. That's money you keep working for you instead of leaving to the IRS today. And for many citizenry, the topper feature is automation. The money comes out of your paycheck before it hits your checking account. At the end of the day, definitely, you don't have to remember to transfer it. You don't have to wrestle with temptation in the grocery store aisle. So 401ks win on release employer money, big part limits, easy automatic saving, and stream tax savings. But remember, every pre-tax dollar going into a traditional 401k is a dollar. The IRS will tax late. You just don't know at what rate yet. In a moment, we'll flip to the Roth IRA's secret weapons, including how it doubles as a flexible emergency bucketful in a pinch. Certainly, if you've ever worried about locking your money up, essentially, you'll lack to hear this. Let's talk about the Roth IRA from a 55-plus perspective. On top of that, number 1, once you hit 5912 and you've had the account at least 5 years, every buck you withdraw, contributions and earnings is tax-free. That's incredibly productive when you're coordinating with Social Security, pensions, and mayhap part-time piece of work. Second, no RMDs during your lifetime. Unlike traditional accounts, the IRS doesn't force you to pull Roth IRA money out at 73. You can let it grow as a backup bucketful for very old age. You can use it to control your tax angle bracket in high spending years, or leave it to children or grandchildren who generally must empty it within 10 years, but still enjoy income tax-free back down under current rules. What's more, third, and this is a big one, people your age often don't realize, you can always withdraw your contributions, the original after-tax dollars you put in, anytime, tax and penalty-free. It's the net profit that are restricted before 5912 and before the 5-year rule. The truth is, frankly, that means if over the old age you put, say, $80,000 of contribution into a Roth and it grows to, $130,000, you could pulling that $80,000 back out if life really smacked you and hush, leave the growth inside to keep compounding. I don't recommend using it ilka look into account, but it's a powerful safety valve. Here's the deal. So, Roth IAS shine for you in 3 areas. Tax-free income later, no forced back down, giving you control over timing, and built-in flexibleness with contributions, and a cleaner legacy for your heirs. The downside, lower annual limits and income phase-outs. That's why most citizenry over 55 want to think in terms of a combination, not 401k versus Roth IRA as a boxing match. Let me tell you about one couple I'll call Jim and Maria. In their late 50s, all their money was in 401ks, no Roth at all. But here's what's interesting. On top of that, when we ran their numbers, their projected RMDs in their 70s would push them into a higher tax angle bracket than when they were work and make most of their social protection taxable. We shifted a portion of their new savings into Roth and planned some small Roth conversions in low-income ELD. The result, their projected lifetime tax bill dropped by over 6 figures. Same people, same work history, different account mix. All right, let's get practical. Here's a simple 3-step order of magnitude many planners recommend, and it lines up with the math we've just talked through if you're 55 or senior and still working. Step 1, capture the detailed 401k match. Indeed, kick in adequate to your 401k or 403b to get every clam of employer match. Definitely, if they match 4%, you put in 4%. If it's 6%, you put in 6%. That Lucifer is an instant 100% return on your contribution. Now here's where it gets good. On top of that, measure 2, max out a Roth IRA. No doubt next, direct savings into a Roth IRA up to your boundary. In 2026, that's $8,600 if you're 50 or older, as long as your income is within the allowed range. This builds your tax-free bucket, your flexibility bucket, and your RMD-free bucket. Sometimes, if your income is too high for a direct Roth IRA, that's where strategies like the backdoor Roth IRA come in. But those need careful tax planning and often a professional's helper. Step 3, go rear and load up the 401k. Once you've taken the match and filled your Roth IRA, if you still have money to save, go back and raise your 401k contribution toward that $32,500 limit if you're 50 plus in 2026. This order blends release employer money, Roth tax-free growth, and high 401k limits and current year tax savings. Let me put it this way. In fact, is it perfect for every bingle person? No. Interestingly, but for many people over 55, it's a very strong starting blueprint. The truth is, to be honest, now let's turn this into 3 concrete game plans you can literally write down and discuss with your tax pro or advisor this week. Grab a pen if you can. I'll move slowly here. And here's the thing. To be honest, Plan A, still working full-time, 55 to 67. Step 1, contribute to your 401k up to the full employer Lucifer. Also Step 2, max out a Roth IRA if your income allows up to $8,600 at 50 plus in 2026. But here's what's interesting. Step 3, if you're in a high tax angle bracket and have nest egg capacity, increase traditional 401k contributions for the extra tax interruption now. Plan B, semi-retired or work part-time. Income may be lower, tax bracket oftentimes lower too. Consider shifting more into Roth, new Roth IRA contributions or small Roth conversions from your 401k or traditional IRA while your tax charge per unit is temporarily get down. What's more, coordinate with when you start Social Security so you do not accidentally bump more of it into the taxable range. Design C, fully retired pre-RMD, say 65 to 72. This can be a golden window. Here's why this matters. No paycheck. Maybe you delay sociable protection a bit. Tax bracket let down. Use that window to do modest Roth conversions from traditional accounts, basically. Filling up lower tax brackets now, so future RMDs and futurity Social Security taxation are lower ulterior. The goal is to arrive at age 73 with a more balanced mix. Basically, some traditional, some Roth, so the IRS does basically completely control your income in your 70s and 80s. Frankly, whatever your situation, the theme is the same. Don't just ask which is better, 401k or Roth IRA. Ask how do I arrange these together so I pay the actually least tax over my lifetime, not just this 12-month. Obviously, if you've ever looked at your 401k balance and thought, will this actually be enough? I want you to remember this. It's not just how much you saved. Frankly, it's where you saved it and how you take it out. Truth is, a smart mix of 401k and Roth IRA tailored to your age and income can mean more money in, actually, your pocket, less leaving to the IRS, and more peace of mind that you won't outlive your savings. If this video helped you, do 3 things for Uncle John. 1, hit that like button so quite more people your age see this. 2, subscribe to Uncle John Financial for more straight talk retirement videos. 3, drop a comment with your age and whether you're Squad 401k, Squad Roth, or Now Team, why not both? I'm Uncle John. You worked hard for that money. But here's what's interesting. Let's make sure you, not the IRS, decide what happens to